Looks like that's good. All right, good afternoon and welcome to my talk on earnings plays, a completely new system. I've been looking forward to doing this presentation because earnings plays are so interesting and fun, and because we've got some fascinating new approaches to show you. I'd like to take a moment to put this kind of trading in perspective. Many of you are familiar with the VXX trading system as presented in several recorded webinars over the past couple of years. That system has been working well, and that's where most of your money should be. At least that's the way I view it. Or we have many customers who trade the income-producing strategies such as iron condors and butterflies that are taught in our Discover Options series. That's another good place for the bulk of your money. And I know that many OptionVue customers have, some of them $1 million or more invested this way and pull in a rather steady income. So the options markets can handle this kind of volume easily, and so can the VXX and the other volatility products. So these are your heavy lifters, if you will. So earnings plays, the topic of today's talk, are more for entertainment. At least that's the way I look at it. And yes, you can make money at it, and towards the end of my talk, I'll be showing you my own track record so far. The great thing about earnings plays is that they are, well, entertaining. They provide a nice diversion from managing the other things like the VXX trading and iron condors and so on. Those strategies can be rather boring, as most days there's nothing to do, or at least there shouldn't be. I know for a fact that some of our VXX trading customers are over trading. They're in and out pretty often, and too often, I think. And I feel sure that that's going to hurt their results. So with these earnings plays, well, they might just be the thing to divert their attention and help them leave their other positions alone. I know it helps me that way. Earnings plays are so interesting because there are so many of them and they're so short term. They're like little lottery tickets, and you can't wait to see how the next one's going to play out. They can be a social thing too. Here in the office, there are 3 of us trading these, and we're always chattering about them and comparing notes. A lot of our development work in the past 4 months has been aimed at producing great new tools to assist in profiting from earnings plays. And as has so often happened over the years, my primary motivation for doing this was my own gain and pleasure, at least at first. But now that I've developed all these new systems, I'm happy to bring them out for all of the OptionVue clients to use. I don't know if you've ever thought about how much it means for an engineering company like OptionVue to be internally motivated in this way. I mean, just the fact that I'm a trader and always will be. Anyway, what we've got is in the servers, there are 6 or 7 new sophisticated search algorithms that find the top candidates in several different categories in terms of earnings plays. And then in the OptionVue program itself, there are several new features for organizing and viewing the trade candidates, managing your trades, and tracking performance. We're going to be talking about 5 different approaches to earnings plays today, and these are the names that I gave them. 3 of these are new. That is, I never read anything about them or heard anyone talk about them, so as far as I know, they're new. And I want to start by talking about the first new one in this list because that's where this all began. It was 4 months ago, and I think I must have been looking at the charts of Visa and MasterCard, and I had noticed that it seemed like that whenever either one of them made an earnings announcement, they both would jump. And I didn't think anything more about that at first, but I was sitting at home on a Saturday, and a light bulb went on, and just thought popped into my head, what about buying a straddle on the secondary stock, the one that's not making the announcement that day? And I drove into the office just to investigated a little bit, and I ended up spending 3 hours poking around using Backtrader, and I got really excited. Let me show you just real quick here an example of what I was seeing. We'll bring up a price chart on MasterCard, and we've got the earnings marked. So let's go to this first one. This is the earnings announcement day for MasterCard, and we'll switch then to Visa. And we find that Visa announced on the same day. So actually, this is a non-event. This is not tradable when they both announce on the same day. Let's go to the next one. And on this day, MasterCard dropped, and so did Visa. I don't know if you can make it out, but Visa dropped about 5 points here. And then we'll go back and look again at MasterCard. The next announcement that it made got a positive reaction from the market, and a positive reaction happened in Visa as well. And then we go to the latest one. Looks like something disappointing was announced, and Visa also dropped. Now, the great thing about both of these stocks is that they have weeklies, and in my trading, at least in buying straddles, I like to buy the nearest options available. Sometimes they only have 1 or 2 days, and so the leverage is tremendous. And the result is that you can make some good money on your straddle. What I found that day in my research that was real surprising was that the options on the secondary stock are not inflated whatsoever. They're just sitting there at normal vol levels. And that was exciting to me because I thought, well, you can buy a straddle, and if the thing turns out to be a dud, you can sell it back for just a small loss because you've got just 1 day's slippage, 1 day's time decay, and a little slippage. Let me show you another example that I found that day that also got me excited. Maybe you can recall this announcement last October by Google. Google went up more than 50 points that day. And look at this companion move by Baidu. Baidu went up about 18 points that day. And it so happens there were options available prior to the announcement that had just 2 days to go with big leverage. So this would have been 15 times your money. And then I got real excited, and I started to think in terms of writing search algorithms, especially the first search algorithm to find these great pairs. Okay, and in the program you can see a list of the top pairs here. We've got the Visa MasterCard one first. It is absolutely the highest ranking one. Now, before you get out a pen and pencil and start writing down all these symbols, I need to tell you that I rigged the program in a special way just for this presentation. You're not seeing the highest quality candidates here. I mean, yes, the Visa MasterCard one is the highest quality one, and I don't mind showing you that one, but after that there's a gap here with about 30 stocks missing from the list. So the rest of the stocks you see listed here are rather low quality. Subscribers will get to see our complete list of high quality candidates. And by the way, we'll come back to this screen in just a few minutes, and I'll explain what all these numbers mean that you're seeing here. Okay, so let's define what the 5 approaches are. We talked about the pairs, but let's go to the top of the list. Prime movers are not a new concept. They're just stocks that make big moves, and you buy a straddle on the day prior to announcement, sell it on the day of the announcement. And despite buying the inflated volatility, often these stocks have a history of making such big moves that the straddle usually pays off. So we have a search algorithm that finds the best ones in this regard. Now, all our search algorithms reach back 2 years, or 8 quarters worth, eight announcements. We could have gone deeper, but I don't really want to. I didn't want to because we really want to know what stocks have been paying off well recently in these categories. The next category is what I call the prime non-movers. These are stocks that make smaller than expected moves. You buy a calendar spread or sell a straddle, maybe a naked strangle or something on the day prior to announcement and close it on the day of the announcement. Selling the inflated options pays off because the options tend to be overvalued apparently prior to announcement. So these, this is the non-movers. Now earnings pairs, we talked about already a little bit. It involves two stocks, what we call a primary stock that's making its announcement and a secondary stock that is a company in the same industry which tends to jump with the primary. And you would buy a straddle on the often non-inflated options of the secondary stock. And hopefully if the primary jumps, the secondary will also. Okay, another new concept here. Someone might have thought of this before, but I don't know of it. This strategy also involves two stocks in the same industry. And if the primary stock announces and jumps more than 3% in either direction, and then the secondary stock announces within 1 to 18 days after that, take a position before the announcement that will benefit from the secondary stock moving in the same direction that the primary did. And you would want to be sure to use a spread of some kind so you won't be hurt by the vol crush. Let's switch to OptionVue and show you an example or two of this. I've got one lined up right here. If we open up Hasbro and have a look at its announcements, here's a very positive reaction from this announcement. And we'll switch to the other stock. Now this time there was no announcement within 18 days made by the other company. So this is not a qualifying event. There was no trade this time. Let's go back to Hasbro. And we'll look at the next event. This one also got a positive reaction. And this time, looks like 10 days later, Electronic Arts made its announcement and jumped to the upside just the same way that Hasbro did. So that would have been a big winner right there. Now hold on, we don't want to mark the secondary stock. We need to go back to Hasbro and mark the primary one. It can get confusing if you're looking at these charts and you start putting your wand on the mark of the secondary stock. Don't make that mistake. Put it on the announcement that the primary made. In this case, it was disappointing. And then the other one, just 2 days later, had its announcement and it dropped. So that's an interesting concept, and I'm calling it echoes because the secondary stock kind of echoes the first one. And there's a list of good candidates here. Well, these are actually not the best, like I said before. If you're a subscriber, you will see the best ones come up here. All right, turning to slides. The fifth and final approach is stocks that tend to run on announcement day. There's a strong statistical the thing that's evident when stocks announce, many times they will open at a certain point and then push further as the day goes on. So the concept here with runners is that if the stock opens to the upside, go long for the rest of the day, and if the stock opens to the downside, go short for the rest of the day. And you can use whatever strategy you like. Often I just buy a call for going up and buy puts for going down. But and I'd like to show you an example or two of this. We'll switch to runners here. Let's take the strongest candidate that we have. Actually, that's not it. Sort it. It's this DEX Media. Have a look at this. When the stock opened, it pushed lower. It pushed lower all day, and then this one opened to the upside and pushed higher all day, higher on this case, and then this is actually a failure event here. This would have been a loss for us because it pushed up but then came back down and probably would have ended up being a loss on this trade. Okay, but this stock, you see this number 17.5? This stock has a tendency to move 17.5% farther once it opens. Okay, from the open to the close, 17.5%. So that's pretty interesting, and runners are another interesting way to play earnings. All right, let's turn to the program now, and I'd like to show you the great new features that have been introduced and available for subscribers. You will see that the old orange E is still up here. Well, click that and you now get a choice. The old earnings search window is still here and that's still available to you, but there are two new choices. And let's take the first one to show you this. Import earnings plays. Now this is where you bring the list of the 5 different approaches into the program, and it brings them right into the quotes display. Okay, so this is set up to give you quite a bit of flexibility in terms of the quality ratings and other qualifiers that you want to apply. When you first start using this and you open this form up for the first time, these fields will be filled with what we recommend as far as the default settings. What you're looking at right here are not those. These are more slack. But you'll see that you got 5 sections here on the left for the different types. You got the prime movers, the prime non-movers, pairs, echoes, and runners. And if you're interested in all of them, then you leave them all checked. If you click anywhere in one of these boxes, you can toggle both of those check boxes on and off at the same time. So, and then, okay, you get to set the quality rating to apply in each of these categories. And under non-movers, we give you another choice as well. Do you want to buy calendars, or are you going to be selling naked straddles? Not everyone can sell naked straddles. That takes a lot of margin. And, of course, open-ended risk. So this might not be attractive to everyone. But if you do have a look at selling naked straddles and have the program bring that list in, it is a longer list than the one for calendars, as it turns out. Anyway, what you do when you're ready to go with this thing, I'd like to put this back in calendars first, is click Go, and the program automatically creates these tabs along the bottom if they didn't exist already, these 5 E-primes, overs, pairs, and echoes, and runners, and fills in all the candidates, the top candidates that were found when the search was run. You know, our search algorithms run every weekend. They don't run every night because it takes all day, actually, for all of them to run. And also because there isn't a whole lot that changes from day to day. Once a week is probably sufficient. And on Monday morning, if you're a subscriber, you'll see a pop-up reminding you that fresh data is available, and you can click to go ahead and get into this form and do the update right away. Now, with the lists filled in, you can right-click in the headers. By the way, I recommend you not change the names of these tabs and also not change the names of these group headers, okay, because the program needs to see these have exactly these names in order to do the importing properly, plus the weekly planner that I'm going to show you in a minute. But these, when you bring in a list, it comes in sorted by quality. And you can right-click here in the header to sort by date. That's what I always do, so that I can see what the next candidate is. So the very next one is going to be this VAC in October 9th. Let's go to runners and sort them because there's something coming up real soon in runners Now again, these are the low quality items. You're not looking at the stocks here that you would be seeing if you were a subscriber, but if you want to sort by quality, right-click under Earn Notes. By the way, you're going to need to manually add these two columns. You're going to need to add the earn date, which is not new really. Everyone can get earn date, and earn date's been out for, I don't know, 2 years or more. So earn date has been here a long time, but Earn Notes is new, and you would want to manually add this column. So Earn Notes is here, and if you right-click in it, it sorts by quality, and if you right-click under the date field, it sorts by date. And I want you to notice that the dates progress out in time until there's a breakover point. Here's the breakover point, and from here on down, these were events that occurred in the recent past. Okay, and then they advance again to here. So sorting this way is nice because it makes it so the top event, once it's spent, jumps to the bottom of the list and then gradually climbs the ladder back up as time goes on, day by day. I always like to leave my list sorted by date, so I right-click there and leave them sorted by date. Although it really doesn't matter to anything else, thinking of the weekly planner. Let me show you that weekly planner now. This is really nice. This organizes your whole week with Monday, Tuesday, Wednesday, and Thursday, and you got the morning, you got the afternoon. So this shows you what trades need to be done each day, morning and afternoon. Like for example, open TSL runner, it has a quality of 4.8 and DVO of 1060. You know, this it's pretty sparse right now because we're not in the thick of earnings season. I wish I could show you a screen that's full because it's really nice. You know what? Let me try something. Let's take us back. That's not what I meant to do. Let's take us back in BackTrader to when things were really happening a few weeks ago. Let's go back to the 24th. And let's just see if our weekly planner looks like it did back on that day, because I want you to see this. Yes, it worked. Good. And see how everything's color-coded? The prime movers are the dark blue, and you got the prime non-movers that are this olive color, and the earnings pairs are teal. So everything is color-coded, and this is a really big help when you're in the middle of earnings season and there's a lot going on. I like to print this out and keep it handy on my desk, and keeps me organized. And this takes care of the, this also takes care of the BMO AMC thing. You know, let's close this up. Show what I'm talking about. You know, an announcement is either BMO, which is before market open, or it's AMC, after market close. And when you're looking at these, it can take a little thought to figure out, okay, let's see, this one, this was announcing after the close on the 15th, so when do I need to put my position on? Yeah, I need to put it on the 15th. But this one on the this next one, it needs to be put on the same day because it's announcing the next morning before the open. Well, the weekly planner sorts that all out for you, so everything is placed in the right afternoons and the right mornings as far as opening and closing things. Now, okay, an explanation of these numbers is in order. In the Earn Notes field, the first number is always a quality indicator. Let's sort these by quality right now. This 134 directly relates to the average return during the last 2 years. So the average return was an actually 134% gain per event. All right, and this 34 means it's 34% gain per event. And therefore, it's also, you can also look at it as your expected return. Okay, so expected return 34%, 33%, so on. The next two numbers that have got a comma between them, that's the number of successes out of how many events. So in the last 2 years, there were 8 events, and for Corning, there were 4 profits. The other 4 were losses. Okay, you've got 3 out of 8, 5 out of 8, and so on. And you can look at a chart and very often see why. Now that was one huge success right there. This is not big enough of a move to be a profit. This might have been big enough to be a profit, but you can look back using a chart and see, pretty much tell where the successes were and where the failures were. There are going to be a lot of losses in this trading. You got to get used to that. Each one stands on its own, and it'll either be a loss or a gain. And very often with these straddle purchases, the size of the average gain is larger than the size of the average loss. And that makes sense, right? Because the upside is unlimited with a straddle purchase. Okay, this final thing here is either an O or a C. And what that means is, if it's a C, and most of these are, you're encouraged to hold on to your straddle until near the close. So on the effective day of the announcement, try to hold on all the way until almost the very close, because usually that's where you get your best price. That's what the C means. Now the O means historically it's been better to close at the open. All right, and you'll see the same similar things on all these forms, except hold on, right here in the pairs, what's this doing here? Well, this is your secondary stock. So the primaries are listed on the left. Can you see my cursor? And the secondaries are listed here in the earn notes. You're going to trade the secondary. You're not going to trade the primary. The primary makes the announcement. The secondary is the stock you've got a straddle on right before the primary makes its announcement, okay? And the number in parentheses next to the symbol is the DVO. So Aetna, for example, has a DVO of 495. So this is just put here for your reference to see how liquid the options market is. Here's LinkedIn with a huge 10,500. And the rest of these numbers are as described before. Echoes also have secondary stocks involved, and they're listed here in the same way. Now I need to tell you that, okay, I was talking about the quality numbers. The quality numbers for primes is, like I said, you can look at it as expected return. Same for overs. This is your expected return. The highest quality candidate in overs. Why do I call them overs? Because apparently their options are overvalued before their announcement. And you can expect to make a 53% return per trade on average. So this quality number is also an indication of expected return. And then once again, with pairs, this number is your expected return. When we get to echoes, the quality number is something entirely different. This does not relate to anything in the real world. This is just a relative number. It just means that you got a 30 here and you got a 40 here. Well, this 41 is better. Apparently, the pair of stocks has a tendency to echo one another. Well, it's not mutual, but the one echoes the other more reliably if this number is higher, and that's all that this number means. And then in runners, the number is the percentage move. Like I said once before, this 17.5 means that the stock seems to run 17.5% from open to close. And that's what this quality number means. All right, good. So now I think we've covered the program features. To help clarify, this diagram shows the flow of information. So we've got the server where the search algorithms run every weekend, And on a Monday, the information automatically downloads into your OptionVue program. It's one of the daily files that comes down when you first open the program. From there, you would use the new Import Earnings Plays form that I showed you to bring the lists right into your quotes display. And then finally, from the quotes display, information flows into the weekly earnings planner. So this diagram is just to help clarify the flow of information. Now, comparing the 5 approaches, just to help clarify things in your mind, there are only 2 of these approaches that involve 2 stocks, and the rest involve 1 stock. Prime movers, with prime movers, you buy a straddle or a strangle. With prime non-movers, you buy a calendar or sell a naked straddle or strangle, or it's even occurred to me to try doing iron condors on these, and I've been meaning to do that, so I'm going to start trying those in the future to see how those work out. With earnings pairs, again, you buy a straddle or strangle. And with earnings plays, your strategy is up to you, but we recommend using a diagonal or some form of a spread so that the ball crush won't hurt you. And then with runners, again, user preference. In every one of these, you're going to be in one day and out the next. Let's get back to where we were. Except for runners, where you're in and out the same day. All right? Now, the search algorithms that run on the first 3 approaches actually do simulated trading with historical options prices. They can do that because our deep history of options prices and what we call our archives are available to them. So in figuring out how well a particular stock performs in terms of prime mover, as a prime mover, for example, it actually goes into the past and simulates buying straddles or strangles as appropriate on the day before the announcement, and then selling them the next day, either in the morning or near the close. And so I think this is a superior approach because, for one thing, it takes into account what options are available, for example, whether it has weeklies available with their higher leverage or not, and it takes into account slippage and other effects. So these are really sophisticated search algorithms. Now with echo plays, the algorithm simply measures how well one stock seems to echo another. And with runners, it simply looks at the average percentage move. In the simulated trading, to simulate slippage, I programmed it to go 3/4 of the way from between bid and ask, okay? So I thought that was sufficiently conservative. All right, now with this recaps what I told you about the quality indicators. Okay, so expected return, then echo plays, it's only a relative number, and with runners, it is the percentage move. Okay. What is your weekly routine? Well, your weekly routine is going to be every Monday. Fresh data is automatically copied into your computer. You're going to want to import this data into your quotes display, and then use the weekly planner to view or print this week's trades. Now let's give me a moment to get a drink of water. Then we're going to get into some practical matters. It's been a learning curve for us here, and I don't mind sharing with you the mistakes that were made and what was learned from them. Number one here was not actually a mistake, but it was something I stumbled on. A company can actually announce earlier or later than expected. Now, I've only seen one instance of this, but I just wanted to mention it because it can happen. On that particular day, it was time for me to put on a straddle, and I noticed the stock was up or down 4%. I can't remember if it was up or down. But I said, why is it up or down 4%? So I went to check the news, and sure enough, it had announced already. So that saved me the trouble of putting on the straddle because there was no point anymore. Number 2, don't mess around too long with 1 or 2 day options. When you get down to the point where there's just 2 days of life left and the stock is not moving, it doesn't seem like it wants to move and give your straddle a profit, you might have to get out earlier, because I stayed around too long one day. It was the final day, and the stock was stuck right in between the strikes of the call and put in a strangle, and just wasn't moving. I kept saying, come on, move. But the decay happened so rapidly during the couple hours or 3 hours that I was waiting that I actually lost about $800 fooling around with that. It turned out to be a much bigger loss than it should have been. Number 3, allow a BMO extra time to develop. You know, I think these BMOs, these before market opens, the announcement may come out around 7:30. I don't know exactly what time, but maybe an hour before the open. And my impression from the way the stocks seem to develop more momentum later in the morning is maybe the analysts need more time to go over the figures and make an assessment. More time than just the hour they have before the open. Okay? And so with a BMO, it could take longer to develop. Let me tell you about a big mistake I made one day, and I'll never make this one again. I was in 2 earnings pair situations. Both of them, I had bought a straddle, and I checked the market when I was still at home, and I saw that they were going to open flat. Both of them opened flat, and I just made a quick decision to go ahead and close them because I thought, well, they're not going to go anywhere. I drive to the office and turn on my screen, and I was flabbergasted to see that I would have had a $1,000 gain in both of those if I had just waited till I got to the office. And then later in the day, they became even more. So allow a BMO a lot of extra time to develop. Number 4, don't be an elephant, please. I'm a little concerned about the scalability of these earnings plays, and I really wouldn't want to see killing the market in some of the. You know, you can't go in and buy 50 straddles on some of these. Some of them are a little too thinly traded to be hitting them that hard. So just to give you an idea, I've got an account that's 30 grand, and for each trade, I usually put in somewhere between $1,200 and $1,500 on each trade. So that's what I'm doing. So I'm buying quantities of like 8, 10, and if they're really low-priced options, I have to do 20 sometimes. But I'm a little concerned about scalability here, so don't stomp on these too much. Now, a lot of the stocks do have big volume, so there's no problem with some of them. But some of the others have rather low volume. One question that you might have as you get into this is, how do you handle a situation where a stock is both a prime mover and a runner? Well, there's 2 ways you can do it. You can close the losing leg of your straddle and keep the winning side for the rest of the day. That's probably obvious. And then number 2, you could close the losing leg and buy a little more of the winning side. So, yeah, you can work it either way. When closing out a position on its final day of trading, don't just look at the bid-ask. Also check the intrinsic value, because you're going to want to set your limit price equal to the intrinsic value. Take a look at this example. You will very often see this kind of situation. Here's an option. Here's the straddle that is making a profit, $666, and what you'll see very often is one leg is just about worthless. You can't sell it if you want to. And the other leg is in the money. Didn't mean to. And Now look at the bid ask of this option, 1.22 to 1.78, very wide. Do a computation, at least in your head, of the intrinsic value. Take a moment to do it right now. The strike is 22. The stock is 20 and 41 pennies. What's the intrinsic value? I get 1.59. 1.59, and you will definitely not want to sell for less than 1.59. This bid here is really very deceptive. I want to point this out to you because I don't want any of you handing money over to the market maker that you don't have to. So you should at least get 1.59 for this option, and in my experience you won't get much more. I've actually gone in something like this, tried to get 1.60 or 1.61, and the market maker just sits there looking at me. I don't get it. So very often I do have to hit the actual intrinsic value. So that's a point I wanted to make. Now, yes, sometimes you need to make it a strangle instead of a straddle. And here's a good illustration of when that might be possible. You've got the stock kind of right in between a couple strikes. So you're looking at neither one of the straddles is balanced, but you can create a balanced situation by making a strangle, and that's what I typically do, and both the call and the put are just a little out of the money. So you'll need to do that sometimes. And by the way, my search algorithms also do this. They're programmed to also make a strangle when appropriate. And then sometimes, in addition to strangling, or in this case, it's not a strangle, but you have to ratio also. Look at the calls. The calls are about 1.4, and there's no put that's anywhere close to 1.4. And so I had to double up, or even more than double up, on the puts in this case, just to get delta somewhere close to 0. I don't feel compelled to get delta exactly at 0 when I'm trying to ratio, but I do want to try to get it fairly close to 0. You want to start out with your strangle or straddle as close to delta as you can. Now, here's an instance where I put on a calendar. This would have been one of the non-movers. And I've learned that when putting on a calendar, you need to select an expiration for the long leg that has at least 14 days more duration than the short leg you put on. And that's what we have here with the 2 weeklies and the regular August options. 14 days are between the durations of these, so this is a good way to do it. And in this case, I did a double calendar with the calls a little out of the money and the puts a little out of the money also, to spread out the curve a little bit. This was a winner. This one turned out to be a winner for me. And in another account, I actually didn't do the calendar as wide as this. I did it narrow, and I barely broke even in that instance. So it can be real important to spread it out like this. Now, when trading opens following an announcement, the bid ask can remain wide and the IV is high for a while. There's still some turbulence or uncertainty as to how much movement the stock will make during the day, and so volatilities linger for a while. The vol crush doesn't happen suddenly, but it could take an hour or two, sometimes even 3 hours, for the vols to settle down and for the bid asks to settle down. So often it's important to allow some time for the settling down, especially if you have a calendar on. And with the calendar, you're really not in any hurry anyway, are you? Because time is on your side, and you can just let this bake for a while. Now, it's important to resist the urge to close a position quickly upon the opening. Here's an example of why. You have at the open, the stock opens a big gap, and you think, oh man, I've got a big profit, so I'm take it off right away. Well, you could be missing out on a lot more. because as I've said earlier, there are statistics backing up the fact that stocks often do run further in the same direction for the rest of the day. So be sure to keep that in mind. I want to mention this. As a subscriber, we would ask you please not to share your valuable information with other non-subscribers. OptionVue needs your support on this. All right, it's time to show you my performance analysis here, how my performance has actually been. I've been trading for 4 months. Let's bring up the report here. And the answer is, in a nutshell, it's a qualified success. As you can see, it's practically break-even, a small loss. And it's a qualified success because I want to go over with you what the things are that should be better going forward and the reasons why I'm optimistic. And you know, nothing worth doing is easy when you start out, and we've been on a real learning curve here. All three of us in the office that are trading this are just about at break-even and no better, but we've learned a lot. So going forward, I am optimistic. Let's break these down strategy by strategy. And this is a new performance analysis screen, by the way. You probably haven't seen this before, but it's in your program if you have 7.53. And in a minute, I'll discuss how you set the program up to use this. But if I click on echoes and focus in on this big bath of red ink here, when I click on it, the panel on the right changes to focus only on the numbers about that particular category. And I can toggle this on and off. See that? So with it on, you can see that I've made 5 trades. Every one of them was a loss, because almost perversely, in all 5 cases, the secondary stock moved the opposite direction from the primary. And these were directional plays that were put on. And when you put on a directional play and you've chosen the wrong direction, it makes losses pretty fast. So 5 trades, 5 losses, and I was stunned. I'm very surprised to see this. You know, when you look at charts and you compare pairs of charts, the thing looks pretty compelling. But here you have it in real life trading. It's not working out, and I'm not going to do earnings echo plays for a while. I'll watch them, okay, but I'm going to stand clear of echo plays for a while, and that should make my results $4,000 better right there. Is the way I look at it. Now let's talk about the others as well. In the prime movers, there were 28 trades and a net profit of $2,700 and an average gain of $100 per trade approximately. Okay, looking at this number, this $98, this $100, makes me remember that I don't know how many times, I can't tell you how many times that I would sell a position maybe midday or mid-afternoon and then have a look at it later on towards the close and see that I missed out on maybe $150 or $300 that I would have had if I had held on to it longer. So I've decided to make a determined effort to hold on longer to these straddles and let the stock have all day to finish its move, because another $100, another $150 per trade is going to make a big difference here. And those are my thoughts about this. You may ask, well, why did you sell them midday? Why did you sell them early? Well, you know, I've been trading a long time, and I have these instincts, and one of them is you see a nice gain and you decide to take it. Okay, you want to take it before it slips back on you. And another thing is, when you see it slipping back, you think, well, I can't let that slip back anymore. I better take it off. So it's just the instincts as a trader that I have, and this idea of holding on until near the close goes against the grain of my instincts. So that's the kind of the fight that goes on. The same thing applies to E-pairs. You're holding a straddle on those two, and again in those, holding on till near the close when you're supposed to. Okay, I better clarify that. When that little C is there and you're supposed to hold on to near the close, I've determined that I'm going to try harder to hold on to near the close. Another thing that did happen in the E-pairs was the 2000 thing I mentioned earlier about the closing those out right after the open, closing out those two instances right at the open. This could be $2,000 better if it weren't for that, and that's a mistake that I certainly won't make again. So there's an improvement right there. And then I think I mentioned to you that in the overs, choosing wider calendars makes things better there too. So I see opportunities for improvement in all three of these first categories. And then not to do echoes for a while, it will be an improvement. And then finally you have runners. Runners are kind of a weird animal, and we're still scratching our heads around here trying to figure out, the best way to play them. I've determined for myself that you watch the open and you wait a few minutes. I feel it's good to wait 5, maybe 10 minutes to make sure the stock is headed one direction and is not going to switch back on you. Okay, and then I'll put it on. And even then, I will only put it on if it looks right. Let's get back to our slide. So here's what I'm looking for. I'm looking for decisiveness in the day's move. It opened to the upside and it's pushing farther to the upside. I like this one in the first chart. The second one I wouldn't touch. If that's what it looks like after 10 minutes, then I'm not doing this one. Okay, because I like to see some steady progress being made already, and then I'll jump on board. Now, James here, he likes to jump right on the open, so he jumps in earlier. I don't know. He could be right. We're still trying to figure this out. I've got a small green bar, so we're making some kind of money on it. Right, $781. Okay, so that's my synopsis. I am optimistic. I love doing these. I'm going to keep doing them. And maybe after the next earnings season, I'll be able to show you a bunch of green bars here. I hope so. Now, let's just cover for a moment what you need to do in the program in order for these to come up here like this. How do you get this report to happen? Well, first of all, in the log, you need to open the T-log, and this button right here, Manage Custom Classifications, is the one you need to click. And you will want to set up the classifications just as you see them here. They're the same names as you have in the tabs down below. At least that's the way I do it. And you hand enter these, and once you've done this, you click OK. And the classifications that you set up here are program-wide when you do this. They're not just for this one account. Your whole program, no matter how many accounts you have, will know about these. And then when you enter a new trade, it can come over here and you can classify it. Okay, so you give it a classification like this. And you can also classify it in terms of strategy. Okay, and that's what I do. After every trade I put on, I open the log and I take care of this. I'm going to clear these. And if you'll do that on a regular basis, okay, look at all the way back in time as you go back. I've done all these. Do this on a regular basis, and then this report will work for you. And with classes, you can choose strategies, and you can choose which ones you want. which ones you want included, and then click this again right here. Click this again, and then it shows you your bars for the strategies. Or you can choose classes. Okay, and as long as none of these boxes is selected, the numbers over here in the right panel represent the total across all categories. You can choose to, in the next release of the software, we fixed a little problem that we have. You can now choose non-classified and include that. And now you can see that some of my other trading has been very profitable. This is mostly VXX-based trading here that did this, so putting a plug-in for that. Let's take that away. Now we're back to earnings plays only. All right, we're coming near the end now, but I just want to show you real quickly some of the new features that are going into the very next release of the software. I decided to work on the horizontal skew model. Let's bring up Krispy Kreme donuts. We've got a straddle purchase entered here in the trade fields. And let's go into model volatility, because I want you to see that when there's a future event modeled, that the program no longer uses the CEV model that I developed before. Instead, it uses a new model that's been incorporated called the Johnson model, made by Brian Johnson, a pretty well-known book author who writes books on options and options modeling. And I've incorporated his model, and look how well it works. It works so much better in terms of modeling the actual bending of the curve horizontally that takes place. And you've got a new button here. This wasn't there before. When you click this, it flattens the curve out for you. So with one click, we can model the flattening of the curve, or the vol crush, that happens on announcement day. So that's there. Now let's go look at a chart, and we'll see how these numbers come up and get used. This is our straddle purchase, and when we select the T+0 line and then look at the details, you can see that we're valuing these at volatility of about 53. That's where they are currently. Then when we go to the next line, this line represents the date that's right before the announcement. And so vol is now at its maximum. And that's another great thing about the Johnson model, is that it knows how to model the increase that takes place as you lead up to the day of announcement. So these are now up to 64, which is the projected endpoint for these. And then the next line, if we select the next line, this is the day right after announcement. And as we did over here in the model, we model that the all the vols are going to drop to a flat amount, and that amount's going to be about 40, looks like. So from then on, as we select further lines, you can see that the program is using approximately 40 for its vol. And this is, in my estimation, a great improvement over what we had before. You're getting a much more accurate, more powerful assessment of your position. And now you can do your what-ifing in the matrix all over the place, and the correct projected future behaviors of the volatilities will be in there for you. You may also see that there's some new marks here. You see these little diamonds? Those diamonds represent the implied move. Based on the IVs that are there right now in the matrix, these are the calculated up and down moves that the market's expecting the stock to make. Okay, it'll either move up or down, but this is the magnitude of the move that the market is apparently expecting the stock to make based on the IVs. Then there's this red mark, this red triangle, and this little green triangle. Those are new also. And the green triangle represents the average up move that has happened in the last 2 years. And the red triangle represents the average amount of down move that has happened upon earnings announcements in the last 2 years. So those are in there for your reference. Okay, so getting close to the end now. Let's have a look at, I keep doing this the wrong way. I think it's time to tell you the price. The subscription is $2,400 a year regularly, but we're running a special for the next week of $2,000. So from now until Labor Day, you can get this for $2,000. That includes the weekend, I guess. Labor Day is on a Monday. And if you came into our store, our online store during the weekend, you could still get the $2,000 price. We want to state that because of the nature of this product, OptionVue reserves the right to limit the number of active subscriptions at any time. And finally, it's important to have OptionVue version 7.53 or higher. We'll come out with 7.54 with these new features that I showed you later this week. That's the plan. I've done this already. And that, my friends, concludes the show. Appreciate it, and goodbye. Good luck in your trading. Bye-bye.